Hi everyone, and welcome to another Risk Minds webinar in partnership with Empyrean. Coronavirus stress testing is about to get serious. I'm Adam West, Program Manager at Risk Minds, and I'll be your moderator for today. But before we get started, I just want to remind everyone that this is an interactive webinar and you can submit questions anytime through the Q&A box. There will also be some interactive poll questions, so please do get involved. It's also a good time to remind everyone that the webinar is being recorded and will be available on demand through the Risk Mind channels. So without further ado, let me introduce today's speakers. Joining us today, we have Matthias Kussens. Matthias has been driving large enterprise risk and finance transformation projects for over 10 years. He frequently speaks at industry events around disruptions to the risk and finance function. Matthias is based in Brussels and responsible for the EMEA market. We also have Pete Mandeville. Pete has been delivering risk solutions for most of his active career. Nowadays, he's excited about the possibilities new technologies can offer to the next generation risk solutions for financial institutions. He moderated our panel discussion on the Amsterdam Risk Minds event in December on the future challenges of Basel IV and where stress testing was a key topic. Pete is based in Bangkok and is the overall responsible for Empyrean's risk solution offering. So let's get started. Matthias, take it away.
Hello everyone. Plenty of metaphors have been used lately to analyze the current COVID-19 crisis. Lengthy discussions about whether it's a one-time rare thing with a big impact, something more recurring in nature, maybe we should have all seen it coming. I'm sure you've seen plenty of articles on grey rhinos, black swans, maybe even black jellyfish seen fly by. But it's not what we will be discussing today. What we do want to talk today is to show you with concrete examples how COVID-19 is impacting the risk function in a financial institution and how stress testing is going to become the norm. We'll start with having a look at the macro side of the story, looking at the global economic impact, support measures put in place by the government, as well as the operational changes and the impact all of these have on financial institutions and their systems. Pete will continue with looking at the effects on a more micro level, looking at the different risk impacts, before moving on to the main topic of today, which is the stress testing framework. One of the biggest difficulties of the current COVID-19 crisis is no doubt the uncertainty, both from an impact point of view as from an outlook point of view. It's never been so unpredictable. So if we look at, for instance, an analysis shared by the OECD in March this year, we look at GDP growth of around 2% for the US, 1% for the EU, and Japan at 0%. I'm sure you're all frowning at these numbers now, because if you look at the projections from the IMF a month later, the numbers look very different, with most indications lower than -3%. Yeah, most of it turns very red. And then some of the indicators I've seen in the press last week show Singapore -7, Belgium -6, and US even -8%. The uncertainty is huge. In terms of potential recovery scenarios, we have the classic VUL shapes. V will be a relatively short recession with recoveries post-crisis back to or even beyond the original numbers. The U shape takes a bit longer to recover, but in the end, we'll get there. The L shape is the worst, as pre-crisis numbers are not reached anymore. Yeah, definitely not in the short-term period. I think we can all realize this is going to apply to some of the sectors in the tourism-related companies. Yeah. Also, the W scenario is being mentioned here and there, whereby basically a second recession would come because of a potential second lockdown, a second wave, and so on. It's, however, clear we won't see a single recession type, and probably more accurate of a prediction is kind of a Y shape on its side type of recovery, whereby we have slow recoveries, yeah, those on the lower end of the Y, yeah, for sectors that have been hit very hard as we speak, yeah. Then we also have the sectors that have done better, yeah, the pharma companies, the Amazons, and the like. People are actually hopeful that as the top branch becomes more productive and prosperous, that will help basically the business at the bottom side of the shape, but that's again uncertain. Yeah. In any case, what is very clear is that we're looking at very much sector-based impacts. Yeah. This will force us to rethink risk analysis practices. Airlines, for instance, are in real trouble. Yeah? Air Canada letting go of 50% of its workforce. Lufthansa agreeing to have a portion of state ownership, something they were always very reluctant about. Even real estate is in the danger zone, yeah? With house price indices expected to decline for the first time in history, up to 30% decline in Australia, yeah? Something they've never ever seen before. So what we mean with this, what we want to show this is, yeah, things are not going to go back to as we know them. We really have to look at sector type of impacts. Now, we all know to limit the long-lasting impact on the economy, governments have launched a series of unprecedented support measures as a response. Yeah. I'm not going to go into too much detail, but we've all seen lowering interest rates, tax deferrals, states acting as guarantor in guarantee schemes to provision of bridge funding for temporary financing. But also, governments have urged financial institutions to play their role, and almost a little bit with a tone like, now it's your time to step in after we bailed you out in 2008. So urging financial institutions to keep on granting loans in an effort to revive the economy. A bit of a contradiction there, to be fair, because yeah, at one time you would expect provisions to go up, because yes, we do know that some sectors are going to be hit very hard. At the same time, governments do not want financial institutions to be overly strict on granting new loans. Governments have introduced payment relief plans, whereby for periods 6 months, loan payments can go through a grace period. Unfortunately, this being done without having checked this first with the banking sector, leading to quite a bit of issues we've seen on systems not being ready to support this. Also, specific reporting sets have been introduced. Reporting sets to report on the impact of COVID-19. Regulators have introduced daily liquidity reporting or twice a week reporting of liquidity, LCR, and so on and so forth. Last but not least, there's also been an operational change. Yeah, some institutions had to go and relook at their operational resilience. Yeah, is there a risk that the organization can no longer operate very well? Is there a high key person's risk? Those are things that were always part of the operational risk analysis, but still they become more and more important. Should we ensure that key persons can actually not meet in person for a longer period, thinking about one key person infecting the other? And then, of course, the overall further shift to digital. Yeah. Those institutions that were ready for working from home setups have not been hit that hard from a business continuity point of view. Also, the whole topic of moving more functionality into the cloud will get more and more important. We won't be zooming in too much on the operational side of the story today, but please check our social media space for more detailed breakout on this topic. Yeah, but I mean, what's one of the quotes that I liked is that the most influential chief transformation officer is actually COVID-19. So I think what we can all agree upon from a macro level, yeah, COVID-19 surprised us, at least most of us. Yeah, I mean, we all do know the stories whereby Wimbledon got like a pandemic insurance payout. We also know the stories of Bill Gates doing a TED talk in 2015 warning about a next outbreak. But in the end, I mean, we can all conclude that there's no such thing anymore as business as usual. It will now come down to who can prepare best for what's to come. Nations, they do worry about the second wave. Can we prepare for this? So we didn't see it coming, that's fine. We are still uncertain, okay. But can we prepare for what's to come under a series of scenarios, what-if analysis? Let's have a look with Pete on the micro impacts on the risk function and then how to tackle this from a stress testing point of view. Over to you, Pete.
Hi guys, can you hear me?
Yes, Pete.
Okay, sorry for the interruption. The line broke, but just to continue with the story. So Matthias has basically introduced the global environment and Corona with the level of uncertainty which has never seen before. But what I want to do is to see practically how we can use lessons learned, because Corona is manifesting itself in a quite specific way, in a quite peculiar way, in the sense that it is very different from other crises. It impacts the financial institutions very differently. So we can extract some practical lessons from that and also see what banks can do to prepare for the future, so to speak, in their stress testing for potential either second waves of the same pandemic or a new crisis altogether. So what I wanted to start with is to go one level deeper from Matthias' explanation on the different impacts of the coronavirus, which is on the microeconomic level in the first place, but also on the support measures and on the lockdown on the shorter term. These are all very specific impacts, and what we want to do is to quickly run through the very high level ways of how this manifests itself. So how these forces, these three forces, distinctly manifest most of the financial institutions' financial indicators. So if we look, for example, at capital and provisions, so we are mentioning that at the same rate because capital and provisions is, at this point in time, it's all about the credit risk, and everybody is basically was looking out to the results of the banks and the Q1 report season, just to see in how far banks were increasing their provisions for their expected credit losses, because we all expect huge credit losses to occur. We just are having a very hard time to quantify, or at least we are looking to banks to see how they quantify this credit loss. And here we can already distinguish between a short-term and a longer-term effect. The shorter-term effect on the credit risk it's very specific to the Corona crisis, in the sense that, as far as I can remember, we have never lived through a lockdown period where everybody was sitting down and whole industries were closing. And the support measures were equally dramatic, in the sense that we have been banks have been instrumented to support the economy, to for example grant payment relief for their customers, etc., etc. So all of that, of course, has a short-term direct impact on the credit losses that a bank should expect. But the specificity of this situation here is that the quantification of that impact is quite difficult at this point in time. Why? Because the support measures themselves are designed to prevent defaults from occurring in the short term. But in a certain number of cases, we all know that after the support measure is over, that that some percentage of companies will go bankrupt, either by the short-term impact or by just a structural decrease in demand within the relevant economic sector. So while we are living through these support measures that are typically 6 to 12 months time period, many of the loan portfolios or banks are under payment relief schemes where by nature observed defaults would be delayed in time to a point in time after the support measure has ceased to exist. So that by nature means that for financial institutions it's very hard to gather information on the evolution of the default risk as a consequence of the corona crisis in the short term. Then in the longer term, the challenge becomes even larger because that relates directly to Matthias' starting point to say, okay, where we are heading with the overall economy is a question mark, right? Nobody dares to give a very specific estimate or forecast. So the bank's ECL numbers or expected credit losses are the resultant of a scenario-based weighted ECL, right? So in order to calculate the ECL, we know that the short-term impact is hard to estimate because we don't have data on defaults that is accruing, but what we also don't have is a credible source to say, okay, what is under that weighted scenario, for example, the business as usual scenario, what is that business as usual scenario for the moment? There is a range of forecasts that could serve as the definition of the business as usual scenario, let alone that banks have ready-made answers to the question, what is a severe downturn? From where we are now, if it's hard to say what is the business as usual, then what is the severe downturn, which is relative to the business as usual? So these are all things that are just first time that banks have been put in a position that that they need to take expert judgment to answer all of these questions rather than data, because the data has yet to be assembled on all of these things. So credit risk is short-term impact, long-term impact. There is two different forces when dependent on your time window. Now let's look at, for example, earnings. What is the impact of Corona on earnings? So also there on the short term, obviously we have the lockdown dramatically decrease in economic transactions. So overall, there will be less revenues for banks to be had because there is overall less economic activity. On the flip side, some of the relief measures are still designed to bring in interest revenues. So there is an overall expectation that the earnings from banks are, from an interest rate or interest margin perspective, under huge pressure on the short term. And this is something that can be quantified because we are living through these lockdowns. We know what they have done to the economic activity in the sectors, so banks can accurately assess what is the short-term impact on the earnings. But the long-term impact is somewhat more tied to the global economy at large again, because the corona crisis has forced governments to initiate or reignite massive quantitative easing programs. They don't want to call it they have switched on the money press again, but that's effectively what is happening. So massive purchase programs for securities, together with printing money, etc., etc. So that all accumulates into a massive increase of the money supply in the overall economy, which will lead to a downward pressure on the interest rates for a long time to go. So as far as analysts are looking now, the low interest rate environment that we already knew before the crisis will be extended for X number of years to come, even partly because of the government's reaction in terms of the quantitative easing on its own. So earnings on the long term will be under pressure. That's also something that we already know, be it hard to quantify. But we should also realize that from a regulatory perspective, I think regulators are most of the time not so concerned on downward pressure on profitability in the short term for banks, but when it becomes a structural problem, a multi-year problem, then it becomes another story, because then the banks are basically, if the profitability is low, their capacity to increase their capital is low as well. So low profitability for a long period of time might lead to capital pressure in the long term as well. So these things are linked again, right? So what about the liquidity? Same story there. Short term, what happened? Well, we went into a lockdown, which is for everybody the first time, also for managers, for all the companies across all the economic sectors. Nobody knew what to expect when we entered the lockdown period. So how long was it going to take? What is the impact? The only thing that both households and companies alike, the only thing that they do know is during a lockdown period, the fixed costs keep on running, right? So your revenues are dropping dramatically, or even going back to zero altogether, but your fixed costs will still run. So you still need to pay these fixed costs. So the only thing that people do in that kind of situation, whether it's in a private situation or as in a management responsible situation, you are going to stockpile cash. You are going to make sure that you have enough cash aside so that you can cater for these fixed costs, that you can survive the lockdown period, and even if you don't know how long the lockdown period will last. So on the liquidity side, you saw massive stockpiling of cash by across economic sectors. That can be witnessed by ballooning deposit accounts on the bank side. So what does that mean from the liquidity side? From an LCR perspective, if you have a sudden but massive increase in your deposit base, it also means that for LCR purposes, you will have an equally massive increase in your short-term deposit outflows. Because these are calculated as a fixed percentage on the balance of the deposits anyways. So the LCR massively, the denominator of the ratio massively increased. So that put a lot of pressure on the LCR ratio itself. So what banks needed to do in that situation is balance out the ratio by increasing the denominator by actively purchasing highly volatile liquid assets. So that's what they did to offset this decreasing impact due to the deposit base, right? So that's the short term that we saw during that manifested itself right before and during the lockdown. But in the longer term, also there, liquidity, even though overall liquidity is not the biggest concern of regulators, overall the long term might become a liquidity issue for banks anyways, because you can only survive that kind of pressure for a certain number of times. So there is growing concern on that liquidity might come in the picture in the longer term as well. And finally, for leverage ratio, even for leverage ratio, where you have, regardless of the riskiness of your business, there's still the leverage ratio that regulators put in as a backstop for leveraging the balance sheet. So banks cannot increase their asset size as they want. There still needs to be a certain 3% of the capital against the assets, regardless of the risk rates, right? So that's the leverage ratio. But what we mentioned is that the companies were massively stockpiling cash because of the lockdown period. So that means that they also massively drew on their credit lines on the banks. So what you saw here is again a very abrupt and strong increase in the denominator of the leverage ratio, because all these off-balance sheet commitments very, very quickly became on-balance sheet assets, which increases the denominator of the leverage ratio, which is again something that regulators were not too happy with, because they don't want the leverage ratio to impede any supporting measure that they want banks to do, i.e. grant loans to the overall economy. Right? So this is a very high-level impact of the corona crisis on the financials of the bank. Obviously, this is something that's a lot of further studies and research will no doubt learn us more on how these things materialize in more details. But high level, I think that these are the major forces that we can attribute directly to corona. So But we don't want to expand on any of these specific subjects because that would basically not allow us to talk about what we want to talk about today. Is the practical lessons that we can learn and practical advice that we can give specifically to handling the corona crisis from a stress testing perspective. So we want to look at ways that banks can, instead of trying to reinvent the wheel, but from a practical point of view, what should financial institutions do to be ready for the future, a future which will be, as it's called, the new normal, which is going to be different than the old normal, but we don't know how it's going to be different at this point in time. So what can you do in that kind of context? From a practical perspective, I think we can distinguish between a short-term and a long-term approach to managing or reviewing your stress test framework. The short-term view would be looking at mainly the short-term impact, because this is what we can do. This is what we know. We are in the to the back end of lockdown periods. We do know the details of the supporting measures. We can actually bring this additional information into our stress testing framework. So that's one thing that we can do. We can model supporting measures, for example, in the short term. However, we still do not know how the macroeconomic picture will fall out in the longer term. So we can, it doesn't make sense at this point in time to try to revise or overhaul the whole risk architecture and initiate large-scale programs to design a process and a system from scratch. Rather, we want to, first of all, focus on modeling these short-term impacts, i.e. supporting measures, because as we have shown before, they impact all of your financials in their own separate ways. And we want to do that under a large number of scenarios. A large number of scenarios, since we don't know how the economy will evolve. The only thing that we can do is pretty much calculate the impact of many scenarios, so that as we go along and we learn of where the economy will eventually end up, which path it will take, that we at least can evaluate the impact of our specific institution very quickly. So now is the time to run these things, so to run that analysis under a very wide range of scenarios, so basically with our current process, right? And if we talk our current process, then we try to, in a very simple way, to visualize the building blocks of that stress testing framework as it exists today. Right? Of course, it's a simplified picture. It's a high-level picture. But more often than not, we are seeing that risk measurement is based on the notion of risk segmentation, where the risk segmentation is basically starting from the concept of grouping kind of homogeneous segments of your balance sheet and to measure different risk types based on these segments, right? In this example here, you see, for example, an SME segment, and that SME segment, dependent on whether you want to measure credit risk or liquidity risk or interest rate risk, you are identifying the specific risk drivers and the risk factors for that SME segment in the context of that specific risk measurement, right? So risk factors are linked for a specific purpose on that SME segment. And then we have, together with that segment as well, we might want to have a certain set of cash flow assumptions that we also take into consideration in our risk measurement. And the third component is the regulation. If we measure risks, then we need to also look at what are the boundaries or what are the guidelines from a regulatory perspective. So these three components are defined on the segment level and are attached to a segment. And we are then running scenarios, macroeconomic scenarios, which are basically attaching these risk factors, attaching these cash flow assumptions to a certain macroeconomic scenario. So you would end up with certain sensitivities for certain risk factors to one single scenario. And equally, you would end up with a certain cash flow scenarios that are attached to a certain macroeconomic scenario. And that is the way that firms are typically handling their stress tests and their stress tests. And this is something that, again, practically, we don't need to reinvent any of that. We are going to use that same framework, that same process, to do the two things that we suggested to do in the short term. So first of all, we are going to run a large, so what we should do is to make sure is that our current process enables us to run a large number of macroeconomic scenarios. With our current process, with our current segmentation, no changes structurally to the process, to the framework. There's no time for that in the short term. But we do want to cover a wide range of macroeconomic scenarios because that's a very prudent thing to do in the times of uncertainty. So practically, what you want to do is to basically estimate your different risks. So to manage your reference data, and I don't know if this is playing. Don't see anything moving on that screen when it was, so let me try again. So what you need to do first of all on the stress testing framework is to make sure that your current process allows you to quickly define new scenarios, new macroeconomic scenarios, and to quickly attach forecasts on these scenarios. So that's number one thing that you want to do right now. If your current system does not have that capability, that's something that you want to address, because what nobody could foresee with the first wave of Corona, we cannot say the same thing with a second wave of Corona, which many experts are already suggesting, right? So basically, we should anticipate that new lockdowns will happen again, and that we don't know under what economic scenario this will all evolve. So we need to be able to do that in a very fast way. So define flexibly new scenarios for the macroeconomy and assign a series of forecasts to every of these scenarios, whether they are BAU, severe down, etc., etc. You want to just cover as wide of a range as possible. And secondly, you want to also make sure that you can model what we have mentioned. What we can mention is the support measures. For example, payment holidays. So the payment holidays is something that is very specific for Corona, but that unfortunately many risk systems and stress testing frameworks are not supporting to be modeled flexibly. However, banks were forced to deal with them in a very fast and flexible way because they were pretty much imposed on banks with a very short time window. So let's say almost overnight, banks faced the reality that they should grant payment reliefs to customers, and it was left up to them to basically find out how to measure the impact of that on all their financials. So that's something that surprised them. But again, here, it surprised the first time, but it should not surprise the second time. Meaning that if we are ready, there is a reasonable chance that there will be a second outbreak of Corona, then we might want to already model a similar kind of support measure to be initiated towards, for example, the winter time in Europe, where the virologists are expecting the second outbreak to happen. So why not model the scenario where a new grace or a new payment holiday would need to be granted for another 6 months, which starts on the 1st of November. These are capabilities that you already know that are required to model a Corona stress test. and that you also know that are potentially, if not likely, are going to be required in the future. So I think that is leading us to the first poll question.
Okay, let me take this one, Pete. So first poll questions, please keep it interactive, guys. Do your source and risk systems accommodate modeling of the government support measures, for instance, the payment holidays that Pete just discussed, both for current as for potential future payment holidays to be put in place again? Yeah, so we have a couple of potential answers there. No, our source and risk systems do not accommodate for that. Yes, for the current payment holidays. Yes, for both current, and we can also model future grace periods. Or yes, both current and future, and all of this scenario based. Yeah, so you could assume that in a downward scenario that maybe this payment holiday is going to be extended for some time. Yeah, aside from 6 months, maybe now goes to 9 months and more. So later we will also discuss the results of the poll questions. So I'll give you a bit of time to go through this. Okay, maybe let's carry on. Pete, back to you.
Okay, thanks, Matthias. So far we have tried to explain the different forces, short-term, long-term, on the financials. We have tried to extract some practically feasible improvements that we can start to implement or should be already implementing at this point in time. But all of this will not survive in the longer term. And one of the reasons for that is directly tied to the to Matthias' story, where he was painting the overall economic environment and the uncertainty around it. And one of the things that we learned from that is, regardless of the economic indicators like a GDP, will we end up with -4, -6, -9% in a given country? These are very interesting statistics for macroeconomists and for everybody that wants to monitor the global economic environment. But unfortunately, that does not survive going forward for a risk manager from a financial institution. And the reason for that is also already explained by Matthias, or indicated by Matthias, is that the -6% is actually a global number which hides a very large variability in terms of the economic sectors that are constituting the overall economy. So some sectors are almost vanished because of Corona. Other sectors are probably in for an L-shaped recovery. We're thinking about, for example, aviation or tourism. So these are sectors that probably are in for a very long recovery process. Some might even argue that the levels, the economic output levels for some sectors will not recover to the pre-Corona periods anyhow. Some sectors were quite neutral on Corona, and some sectors even benefited. So -6% GDP is interesting. It's useful information, but it's not sufficient for our risk management. Why? So that's the variability that we need to do. Because again, let's go back to our stress testing framework, right? So you have that SME segment, you have that corporate segment, you have that consumer loan segment. So all these traditional segments are very often based on a product view of segmentation. So SME loans is one category, but there's a great variety of economic sectors attached to the borrowers within the SME loan portfolio. And the same holds for corporate segments, the same holds for consumer loan segments, etc., etc. So just analyzing the risk factors for a SME segment and predicting how they will move in certain economic scenarios on the overall segment level, SME segment level, is going to be inaccurate at least. What we should aim for and what we should model is how these individual sectors are behaving within the SME segment in any given macroeconomic scenario. So we need to somehow include a economic sector modeling layer that overlays our current segmentation and that will allow risk managers to model their risk factors, to model their sensitivities for these risk factors for any given scenario in a much more granular way than is currently the case. Because the SME segment itself, the corporate segment itself, we can no longer claim that it is not risk sensitive and we didn't know about it. We do know about it. The corporate segment, from a risk perspective, is kind of a meaningless or a very high-level group. The real risk sensitivity should take economic sector into the equation. So that's the longer-term view in redesigning the stress testing framework that we are suggesting is, again, no need to reinvent the wheel. Risk systems, the risk methodologies, I don't see any immediate and practical problems with how we calculate PDs, how we calculate other risk factors, how we model cash flows, etc., etc. So the current methodologies that are being used as best practice standards across the financial industry, I don't think that they have failed. But we should be using them in a more accurate way, and we should be able to model the parameterization for each of these economic factors differently. So this is this is about creating your or updating your segmentation. So basically, going back to the previous slide, the overview slide. So making sure that your stress testing framework allows a user to flexibly define a sub-segment on top of the existing segments, and to model the risk factors that are driving the different risks for that given economic sector, to also attach the sensitivities to that economic sector, so that you can run your stress tests and basically have different behaviors or different correlations being taken into consideration. So I think in the longer term, this is something that we can already learn, even if there is a lot of uncertainty and even if we don't know half or 10% of what we ultimately will learn from the corona crisis. I think it is a safe assumption to make that the economic sector will evolve into a much more important concept for risk modeling in general. So the current segmentation will need to be updated, and we will need to be able to model the different risk factors, different sensitivities, and to be able to stress test these on a more granular level. So this brings us to the first poll results. Matthias, you want to run through them?
Yes. So we asked, do your source and risk systems accommodate modeling of the government support measures, for instance, payment holidays, both current and future? The majority of the people on the line say no. That's a little bit also the feedback that we've been getting from the market. Yeah. Whereas, I mean, there's almost only 10% that basically can do it for both current, future, and also on a scenario level. So that's almost like the status that we want to be in, the the last bit, but there's of course a lot of work for the industry there to set up these to accommodate for the payment relief schemes. Yeah. Let's maybe have a look at the next poll question. Are you able to flexibly define sector-based segments on top of your risk models and run simulations, yeah, to enable stress testing using sector-based lagging? For instance, you have a GDP that has different lags based on the sector that you have as clients, and so on and so forth. So, are you able to define that flexibly? So again, similar to the previous one, we will show the results in a couple of slides. Yeah, this I think another interesting poll question there. Okay, Piet, over to you.
Okay, thanks, Matthias. I think that this was interesting to see that the work to be done is massive, and that I think these short-term modeling capabilities are really something that are going to be center stage for in the very short term, I believe. Right? So continuing our longer term story. So the first advice was in parallel to the short-term modeling capabilities as what we mentioned, the support measures modeling, and also the flexibility to run a wide range of scenarios. So this is something that that financial institutions should start working with. You know, the poll questions indicate that most of the audience considers their financial institutions not to be quite there yet. So that's hopefully work in progress or will be initiated. But at the same time, in the long term, banks can already start to analyze how to include that economic sector modeling layer on their current framework. And we want to give a second long-term requirement, at least as far as we can see, is again looking at the same stress testing framework, but now we have included these short-term modeling requirements. We have included our economic sector modeling layer. So the last piece that we think will be gaining traction and importance in the future is the addition of the regulation as integral part of a stress testing framework. And why do we think that this is relevant? Now, maybe some anecdotal evidence for this. We said that ECL, for example, for the moment during the support measures, firms are flying blind or blindfolded because we are basically freezing the accumulation of data on the observed default rates. So whereas the PD ECL worked to prepare buffers for banks prior to the crisis, PDs do not offer a very good guidance in the midst of the crisis. That's what we are witnessing now. Secondly, market risk, for example. Market risk, there we have some experience. We have had some market-related global financial crisis, and the current market risk framework is requiring banks to hold capital for a value at risk measure of their market risk, both a normal value at risk and a stress value at risk. Now in March, the stress value at risk, I should say, is the worst period of volatility that can be witnessed in the historical data. So these stress VaR models were not able to come in the neighborhood of the real losses that were incurred due to the volatility of the market back in March. And within the regulatory framework, there is punishment. There is a very harsh punishment on models that are not capable of predicting the real losses. We call that models that fail the backtest. So there was a lot of failure on backtests, meaning actual losses far exceeding the expected and modeled losses, even using a stress VaR model, because the crisis is just much worse and harder, hits harder than any previously witnessed crisis. So the stress fall would not reach the extent to which the corona hit the markets. Now, in order to, supervisors, they notice that there is this market risk penalty built with the framework, which could quadruple the market risk capital charge, which could be preventing a lot of players from dealing in that market. So they said, okay, we need to maintain the liquidity. We want to absolutely avoid that people, it becomes too costly to deal in the market. So they want to make sure that they can remove that value. So they basically switch off that multiplier for the time being. So credit risk is not helping us. Market risk is from a regulatory perspective, that it's kind of manipulated for the time being. But the same thing holds for leverage ratio, for liquidity ratio. So all of these things, governments just want banks to lend. They actually want to forego many of their own regulations because they need banks to lend to the economy, regardless of the impact on the LCR, on the leverage ratio, on their increases in accumulated credit risk on the balance sheet. So this is basically the last point that we want to share, is to say, okay, as part of your stress test, you should be able to also manipulate your regulatory context in which you are calculating your impact, because these regulations seem to be tied to the scenario in which we are finding ourselves. So we should be able to manipulate the regulations, the regulatory settings per scenario. In this particular example here, that's another anecdotal piece of evidence. IRBB interpreted in risk in the banking book is now being measured by EVE measures that are covering six shock scenarios. And these shock sizes are predefined by the regulator based on the previous volatility in interest rate shocks, for example, per currency. Right? So what we are witnessing is that the shock sizes that are being used in the mandatory scenarios are parallel up to 100 basis points, parallel down to 100 basis points. Now, we have mentioned that we are probably looking at a period of prolonged, very low interest rates. So we might want to refine this piece of regulation, or we might anticipate that the regulator wants to refine that regulation to be for certain portfolios that 200 basis points, it's not likely to happen. Can you imagine 200 basis points happening in the next 1 or 2 years? That's not going to happen. But yet it is one of the scenarios that we need to run for the supervisor. I think supervisors will change that. We should anticipate that. So it should be part of our stress testing framework. So that is the last piece of advice, if you like, or a lesson that I think is a relevant lesson that we learned from Corona, and that it can also offer a practical piece of work that we can carve out, define, and work with and plan out. Right. So I hope that with this message, that there is some practical insights that can be used by some of you. So that brings us to the results of the previous poll question. Matthias?
Yes, so we asked there, are you able to flexibly define sector-based segments on top of your existing models and simulations? Yes, it's only like, only another 10% that can basically do it in an acceptable short-term period. Yeah, whereby 7.7% says we can do it straight away if you want it, but the majority basically looks at either next end of month or basically doesn't cannot do it straight away. Yeah. Okay. That kind of brings us to the last poll question of today. Are you able to include changes in regulation into your stress testing framework? So basically relating to the last point that Piet brought up, is that we should anticipate regulation changes. Some of it Some of them are not really overly relevant anymore. Maybe we want to play around with some of the parameters in these regulations. So are you able to include those currently in your framework? Okay, we'll give you a little bit of time to answer that. I think at the same time, before we look at the results of that, it's time maybe for a wrap-up. So basically, COVID-19 is a massive disruptor that we didn't see coming. Yeah, that's a clear conclusion. And at this moment, there's still plenty of uncertainty. What we can do now is to make sure our organization and systems are ready to run a whole number of what-if scenarios for a whole range of potential outcomes. Yes, stress your macroeconomic forecasts, do so under different scenarios, many more than the ones you used to do. Play around with payment relief, future second waves, potentially missing payments, and so on. Change model segmentation, in the short term. Change your segmentation longer term, like using sectors as a differentiator. Look at the cash flow patterns and so on. But then last but not least, also anticipate regulation changes. Yeah. So because we do really expect them to come. So let's have a look at the results of the poll. So are you able to include changes? And there we have a combination of different answers. Actually, 1 out of 3 almost says yes, we can play around with those settings relatively easy. But yes, I think around the remainder of the people, around 70+%, would involve quite a bit of work. Yeah. Okay. So maybe let's move to the last slide, which is the slide ready for basically some Q&A. Let's maybe take over there for some of the questions that we've received from the audience. Yeah.
Brilliant. Thanks, Matthias and Pete, for a really insightful and dynamic discussion there. So we have had a few questions come in from the audience. So I think this first one, if I direct it to you, Pete, where do you see regulation changing?
Yeah, so I gave some anecdotal things that can be improved or causing troubles for the moment, or at least some constraints. But overall, I think I would probably think that the overall mandatory scenario and stress-based regulatory measures is something that I would expect to materialize post this crisis. By this, I mean predefined scenarios for which to run your RWAs, your ECLs, so it will. I think how pandemics are modeled in all of these measures is now an exercise that is at everybody's mind in the financial risk space, and that will no doubt lead to conclusions, or at least some requirements around best practices, or maybe government imposed scenarios to include in your risk-weighted assets, LCRs, interest rate risk reporting, etc., etc. So I'm more thinking in broad lines. So having a stress framework being defined across the different measures. That would be my best bet, I guess.
Brilliant. Thanks for that, Pete. We've got time for one more. So one for you, Matthias. You referred to financial institutions having to launch mini projects to cater for payment greater in modelling. So are there some tips you can share from those initiatives?
Okay, thank you. Yes, I mean, I think the first and foremost is let's not underestimate the challenges with the whole modeling of payment relief. We also need to make sure that the source systems are in line with the risk systems. Yeah, that these payment patterns are in line. In the end, I believe the devil's in the detail because we're talking of different forms of payment relief. We're talking principal only, whereby the interest is still assumed to be paid back. Then maybe there is items whereby both payment of principal and of interest are being postponed. But what you do then extend maturity. Yes, while the risk system might maybe automatically then extend maturity, well, that information of the maturity of a contract would normally come in from the source. You see, it could be potentially pretty complex. Also, for those missed interest payments, do we spread them out over the remainder of the term, and so on and so forth? There's not one single view on this topic from the different governments introducing those payment schemes. So yeah, I think that the main topic there is let's not underestimate it. But at the same time, we do get also from our clients quite a lot of questions. Okay, we want to see quickly the impact this has on our expected credit losses, on our net interest incomes, and so on and so forth. I think what's also important is the whole scenario-based concept. Yeah, from what we've seen also from the poll results, is that actually we should even bring the scenario into those different type of payment reliefs into that setup. Yeah.
Right, that's pretty much right. Unfortunately, that is all we have time for today. So I would just like to take the time to thank both Matthias and Pete for their insightful discussion, and everyone from the audience for participating in both the questions and the poll. So unfortunately, I think it's time to say goodbye. So again, thanks Pete, and thanks Matthias, and I hope everyone enjoys the rest of their day.
Thank you.
Yeah, thank you.